and welcome to Fintech Chatter, the show where I chat with fintech leaders about their secrets to success. I'm Dexter Cousins, your host and the founder of Tier 1 People, the executive search firm dedicated to helping high-growth fintech ventures hire exceptional people. With a proven track record of placing top talent in mission-critical roles, Tier 1 People is the trusted partner to many of the world's most recognizable fintech brands. Welcome to part one in a special series on tackling the housing affordability crisis. We're showcasing some of Australia's most promising fintech startups who are developing solutions to solve the problem. And today I'm joined by Lucinda Hartley of Mondas Capital. Lucinda, welcome to the show. Would you mind telling our listeners a little bit more about yourself and Mondas Capital?
Yeah, thanks, Dexter. It's really nice to chat today. My background is actually as an urban designer originally. So I've spent my career in and around property and housing, but looking at it from a whole lot of different angles. And as I guess a curious person, I've spent the past 10 years or so building different companies that look at how we solve niche problems in and around housing and property, and Mondas Capital is one of those. So together with my co-founder Nia Davidson, we have a 0% deposit mortgage product. As everyone would know, we're living in amongst the worst housing affordability crises that we've ever had in Australia, and that requires innovation at every stage of the pipeline. So we're really looking at how we can make it easier for first home buyers and owner occupiers to get into the property market without a deposit, because the deposit barrier is one of the biggest barriers. It's now likely to take you over a decade to save for a deposit, just, as an average family. And by the time you've saved, the property market's out of reach again. So helping people get in earlier without that deposit.
Yeah. I guess if we kind of cast our minds back, 15 years or so, the zero deposit mortgage had a lot of negative connotations to it.
Yeah.
How have you kind of structured the solution so that one, it is a kind of de facto solution to solve the problem, and two, you kind of avoid those negative connotations when you're going out to market investors, etc.
Yeah, absolutely. And look, I think the loan market in general has had some bad reputation over the years. And, I hope that our banking and lending regulations have caught up to avoid that on one point. But 100% lending does carry higher risk, of course. And because it carries higher risk, we've built a whole lot of AI to support the way that product de-risks it. And there's three primary areas that we really need to de-risk. The first and probably the most important is the homeowners themselves. So we're here to help people, not hinder them. And so we don't want to be putting anyone in a situation where 100% mortgage might put them at risk. So that means we need to be looking at people with really good income capacity as a household, good stable income, good earning capacity. We also need to be looking at their credit record and making sure we've got people who haven't got a lot of debts and they haven't had any defaults, and they've got a really kind of clear credit record in that sense. And there are hundreds of thousands of renters in Australia who fit that profile. And these are, everyday working families who've really got great income, good credit history, but with the rise of rent, they're still not able to save for a deposit. So once we've worked with those home buyers and we've, decided that they're people that we could really work with collaboratively, we then need to look at the suburb and the house itself. So Mondus is a shared equity model. The way that we are able to lend 0% deposit at really competitive interest is that we co-invest in the property with the homeowner. So we're not a co-owner. Unlike the government scheme, we don't have shares in the property. The owner owns the property outright like they would. They can do anything with it. They can sell it any time. But as a co-investor, what we expect is that home will appreciate capital growth higher than the average market. And I'll talk about how we do that in a moment. But through that capital growth, we're then able to refinance back what our contribution was after 4 or 5 years, sometimes sooner, sometimes later. So by accruing that capital growth in the property, that homeowner is effectively able to earn their deposit through capital growth in the property and refinance at 5 years rather than having it up front.
Got you.
So, yeah.
You mentioned at the opening your background and how there were a lot of nuanced challenges within housing affordability.
Yeah.
How did you kind of, I guess, recognize, pick this problem and kind of at what point did you kind of go, okay, this is the solution?
Yeah, it's really interesting because having worked in housing my whole career, I haven't looked at it personally from this particular angle and until till Mondus. But there's a variety of reasons, and I think when you look at the housing crisis, there's many factors. There's many supply side factors. There's many demand side factors, and there is a simplistic story that we just don't have enough supply, and that's certainly the political argument at the moment, that we need more supply, and that's true. We do. We have built in Australia less homes than the average OECD country over the past 20 years with per thousand people. So we've got less homes. 1.2 million homes short is the estimate by 2029. But that's not the only factor driving it. So there's also demand side around policy, around capital growth discount, a capital gains discount introduced in the late 90s by the Howard government, combined with negative gearing tax, created property as a vehicle that's very tax efficient for investors, and has created a market where Australia has some of the highest levels of property investment and investors in the world. Now, if all of the other factors around supply were keeping up with that, it may not be such an inequitable market as it is. But when we're really thinking about the market, we need to be looking at not just the supply constraints, which include planning and delivery, but also the demand constraints, which are policy and financing. And so I guess my previous business was in big data analytics for cities, particularly looking at lifestyle and livability analytics, where people wanted to live, where people were moving for, what property developers should build where. And in and of that, it raises a lot of questions that there's a lot of people who really want to be able to buy in neighborhoods which not only have higher growth, but better lifestyle, better health and wellbeing outcomes. And they could potentially afford a mortgage in those neighborhoods, but they can't save for the $200,000 deposit that they've needed to get ahead. And I think with any innovation, in terms of where did this start, in any kind of innovation, you need to break down the problem into a small enough problem that you can solve. Housing affordability is a big and complex challenge that needs all of us providing all of our attention to at every level. But in order to sort of pick one solution where we could really meaningfully have impact right now, the deposit barrier is really one of those big constraints. And for me, knowing this space really well, I guess I personally came up against it following a separation a few years ago, and suddenly found myself back in the housing market, only this time as a single parent and a sole trader, and and a business owner with startup interests. And anyone who's had that combination of things
Yeah.
will know that it's, even though I would consider myself a very reliable person with no debts, that I banks don't I don't fit the profile of a bank. And that made me really curious around how we could actually bring innovation into the mortgage market to provide more opportunities for people.
Mhm. And I guess you kind of that touches on, I guess, the next part that I'm really, I really want to explore in a lot more depth during this series that we're doing, which is really around the challenges. So, I noticed your background. You've had quite a lot of involvement with some of the quite notable VCs in Australia. And one of the things that really strikes me is if I look at that space, we've perhaps got what Airtree and Square Peg in Athena, and there's not really been much input from the kind of VC space into this problem set.
Yeah.
Why do you think that is?
Yeah, well, I mean, first and foremost, a lot of companies looking at housing are also looking at finance in their fintechs, and so any venture capital fund that's set up as an ESBCLP will be prohibited
Yeah,
basically from investing in a regulated company. And companies working with mortgages or any kind of lending are regulated in that way.
yeah,
And so that one ruling makes it really difficult for fintechs in the property and housing market to
yeah.
scale with local finance because of that barrier. So
It's
that's
kind of
one
it's
part of
kind
it.
of crazy, right? When you consider
Yeah,
that, like a lot of superannuation is going into these funds as well,
right,
and you think, we'd want to invest, have a vehicle that invests in our future, right? That's,
right.
yeah,
Yeah, absolutely. I mean, we have a huge amount of Australia's wealth. I think 2/3 of Australia's wealth is in property, and plus all of the institutional money from super funds and others. The majority of that's in property. So
Yeah.
we're heavily invested in that. And look, there are some great people with the FinTech Australia and others who are working on that problem around the limitations for fintechs, because I think it is a really big barrier. I think the other side of it, if you want to look at regulatory environment from a not so much a fintech but from a prop tech perspective, is that we have one of the most regulated building regulation and codes in
Yeah.
the world, and planning restrictions. And as an urban planner, a lot of that is well intentioned. I understand that we need to have good planning so that we're not building homes without good insulation, and that we're building communities that have access to schools and amenities, and they're not houses in a paddock really far away from the amenities people need. It's really important that we have
Mm.
planning, but we also have over 3,000 items in the building code that a house would address, and it makes it very difficult to bring new innovation. So, for example, maybe I've got a great new modern method of construction, or MMC. I might have a great prefab home. It's going to, I could build it, I could 3D print it. There's all this other innovation in that space. But as soon as you try to deliver it on site, you may not fit all of these building codes and regulations, which means it's very difficult to deliver. So in fact, we have a lot of work to do to enable a lot of
Yeah.
those new construction methods to come to life.
Yeah. I guess the other thing that strikes me as well is for such a, kind of, if you look at the TAM, I mean, it's huge. It's the biggest opportunity for fintech
Yeah.
in Australia, without a doubt. And when I look at, yourself, a lot of your peers, incredible founders solving real problems with really kind of innovative solutions. And yet the challenge is how do you kind of get, people to invest in you?
Yeah.
Two, how do you then get the debt, you know, facilities to be able to serve your customers? And it's kind of, we got, all of these small organizations and startups where you got, 3, 4, 5, 10 people trying to tackle massive problems like
Yeah.
this. What have you kind of found from, your kind of personal experience has been the thing that's kept you going? Because it's not like, we give it 12 months and if it doesn't work, it's like you got to give it 5, 10,
Yeah.
10 years.
Yeah, I mean, I think the thing about housing, right, is that your learning cycle is actually quite slow. Like having run a SaaS B2B company, you launch a product, whether you'll learn whether or not it's worked within months.
Yeah.
With a loan product, might be years.
Yeah.
Although I would say that our early indication of growth and customer feedback is showing that is, we've got really great fit and really great traction, really great growth, but it's not the same kind of learning cycle. Like if
Yeah.
you're building a home, it's going to be many years away. So that can be challenging like that. I think working in a highly regulated sector can be difficult because you can see the solution, but then, you're also dealing with problems that you as one small company are not going to be able to solve on
Yeah.
your own. And so it's about finding, really innovative investors and debt facilities who are prepared to structure things differently because they see the opportunity. In our experience, I really think it's come down to whether the individuals in those funds understand the problem well enough to see what the solution is.
Yeah.
Because in some ways, I feel like this is the least risky business I've ever been a part of, because it's
Yeah.
all of our capital is secured against property.
Yeah.
But at the same time, it's a fintech, it's a prop tech. So
Yeah.
and I think that's probably the case with most startups, really. Like if your investors truly understand it and can see the opportunity space, then it's a no-brainer.
Yeah, I think it's, we saw this to a certain extent with the neo banks where, they kind of, the investment horizon was way too short, and it takes
Mm,
decades to build a bank, right? Like,
yeah,
and make it profitable, not a few years. And I think this is kind of one of the challenges that we kind of consistently hear, is just that the kind of investment horizons for a lot of Australian investors
yeah,
are just too short, and they
yeah,
want to, we've heard about term sheets where they want to pull their money out within 3 years, and you think,
yeah,
so it is a real challenge. But having said that, you mentioned before you're starting to have some success. Can you tell us
yeah.
about some of the kind of customer successes that you've had so far?
Yeah, absolutely. Look, we've been really overwhelmed, actually, by the level of interest and demand for this product. So we launched a $100 million debt facility earlier this year. Off the back of that, we've done our first 20 settlements with
Brilliant.
customers in homes, and that's rapidly growing. We hope to do 100 this year. But our waiting list is massive.
Right.
And I think what we're finding is that what we thought that we would predominantly be lending to younger first home buyers, but in fact it's older first home buyers, because if the state of the market, it's
Yeah.
really people in their 30s and 40s, people have been saving for a decade, like they've
Yeah.
been saving hard and just can't get ahead. And when we look at people who are buying in the property market, people don't talk about this so much, but it's often because they've had some sort of family help, the bank of mum and dad. And that's not a bad thing. That's great that we've got people with access to intergenerational support. But for those that don't, you're really stuck.
Yeah.
And so we can be that. So it's couples, like we lent to a really great family. His name's Paul, her name's Bernadette. They live in Perth. Paul's a FIFO worker. They've got 2 kids. They'd completely given up on their dream of owning a home. They didn't think that was going to happen for them, despite having good, reliable income. And so we were able to, within a matter of, I would say actually weeks rather than months, move from approving their loan to finding them a property, and now they're already settled in their home. And that's been a similar story for people around the country. So it's really very real for us when
Yeah,
we
you must
meet
be
the
kind of
homeowner.
skipping to work when you have stories like that.
Yeah, and I think we're still of a scale where we know all our buyers by name.
Uh,
We know them personally, we know the names of their children and their pets. And of course, as we scale, that may not be so much the case, but it means that
yeah.
we're very much involved in their lives and the real struggle. These are everyday middle class families. It's just a very different market to what you see.
Yeah, I remember talking to Alex Badran, the CEO and founder of Spriggy, and
Yeah,
we talk about his first customers, and he's now 10 years on, right? And still talks about those first customers fondly, knows their names, the parents, the kind
yeah,
of problems that they've got. So I think it's one of those kind of things that when you're actually you're having a positive impact on people's lives, and it's a I know this can be a little trite sometimes in fintech where we keep talking about changing people's lives, but I think there is there is an opportunity to make a significant impact, and when you do, it really kind of as a founder kind of sticks with you throughout that whole journey that you're on.
yeah, absolutely.
Now, you've had some wins recently as well outside of customers. Could you tell us a little bit about that?
Yeah, so we were, our capital raising is never easy for any founder, I don't think. But certainly, as we mentioned before, the challenges in fintech are even greater in that your pool is smaller of eligible funds, and you need a lot of money to lend mortgages, turns
Yeah.
out. So yes, we recently last week announced our successful debt facility. So we've raised $100 million debt facility in partnership with a digital lender, Wealth,
Yep.
WLT8, based up in Brisbane. Super innovative lender, founded by 2 brothers, and they understood our solution immediately, and really were very keen to work with us on structuring the capital in a pretty unique way. When we set out to be a 0% deposit lender, we assumed that we would bring the deposit and the regular banks would bring the 80%. But in fact, it's much more efficient and cheaper for the homeowner from an interest perspective if we're able to do one single blended fund.
Right.
And so what we've been able to do through this fund is actually structure the primary and the secondary mortgage in one fund, which means not only does the homeowner just have one bank, one loan to deal with, we're able to do the interest at a really competitive rate, because there are other deposit lenders out there, and
Yeah.
we need all solutions in the market. But a challenge of a secondary mortgage is it attracts a really high interest rate, which
Yeah.
makes it
Yeah.
pretty unaffordable.
Yeah.
Yeah, so that debt fund, and at the same time, we raised an equity. A portion of that was an equity round, together with a VC fund based up on the Gold Coast, Admiralty Capital Group. Some of their founders are from a banking background, and again, they understood this opportunity immediately. They really understand how this this type of market and how capital markets more broadly kind of operate in Australia. And so, we're really thrilled to be able to partner with people like Wealth and Admiralty. I think it's always more than money. When you're looking to invest, it's like, how can you build partnerships that are really going to bring the
Yeah.
expertise and networks to help you scale and grow.
Mhm. And with that investment, what will it enable you to do?
So that enables our first fund, I guess. So we did do a pilot fund last year, a smaller fund with just 10 loans to prove the model would work and test the market appetite, which was massive. So this enables us to reach another 150 home loans approximately. And then we are already, as you can imagine, you spend money quickly with mortgages, looking at how we will increase that debt facility, which initially we have the capacity to do through the current fund, but also looking at other institutional money, because we're very confident that we've de-risked this structure, both with the analytics that we look at and the property growth and the way that we very thoroughly vet the customers, and
Mm.
technology really helps us do it at
Yeah.
both that property and that customer level.
Brilliant. Well, Lucinda, it's been fantastic to find out a little bit more about Mondus. Where can people go and find out more if they're interested in?
Yeah, so our website is mymondas.com, but I should say that very soon we're rebranding the product to Ziru, like zero with two O's, like roo for kangaroo. So ziru.com.au will be our website, but you'll still be able to find us at mymondas.com. That's the name of the fund, and Ziru is the 0% deposit.
Brilliant. Thanks for joining me, Lucinda.
Pleasure. Thanks for the chat.
As always, folks, you can connect with me on LinkedIn. If you're new to the show, make sure you give us a follow if you're listening on podcast. And if you're watching us on YouTube, give us a like and a subscribe. It really does help me and help elevate and support incredible founders like Lucinda. Until the next episode, keep well.